Good morning, everyone. My name is Lance Hocutt, and I'm with the Lance Hocutt Financial Group in beautiful Tuscaloosa, Alabama. Hope everyone had a wonderful weekend. It was a beautiful weekend. Had a little bit of rain on Saturday morning down here in the South, but hopefully wherever you are, it was a great weekend. Hey, we want to remind you this is our second edition of Lance Hocutt Live. We hope that you can join us each and every Monday morning, or at least follow up after on your own time and at your own convenience. But please forward our information out. We'd love to have some live listeners. We would love to have some call-ins during this 9 o'clock hour in Central Time. This is our second edition. Again, our number is 833-375-2623. And you can dial in and speak with us live on the air. And again, thank you for sending questions as well. If you want to send a question to us via email, if you don't want to get online and listen to us, that is fine. Send us a question. Speaking of, this morning I was riding in and I had a good friend call me from down in our area, and he had a question for me, and I felt like it was appropriate for our discussion today. He asked, and this particular person is currently an employee in a public institution. Now, a public institution may be a public government, it may be a school, it may be an institution that is government funded. The difference between that and a private institution or private corporation is a private company. Could be the Lance Hocutt Financial Group. It's a private company. It could be any number of companies in our areas. It could be a Mercedes-Benz. It could be a Nike. It could be a Pfeiffer Incorporated. Those are all private companies. So let's break that down a little bit. His question was this. He's considering making a move from a public corporation or a public entity to a private corporation. Well, there are a lot of things we need to consider when making that decision. Typically, within a public entity, government organization, you have a pension plan for a retirement plan. That pension plan is based on your years of service. It's based on your average 3 high salary. So what I'll tell you is typically we find that that's still not enough. That's why you typically see a government worker that may retire after 25 years, maybe a teacher retires after 25 years and goes to work in a different capacity, or maybe they go back as a contract worker because they need to supplement that income. So let's take it a step further and talk about the ways that they can help supplement that. They can also help save for themselves in a supplemental retirement plan, which is typically offered by that same entity. Now let's shift gears and talk about the private corporation, the corporation that is owned by several individuals or one individual. Well, a private corporation may have what's called a 401k. They may have a retirement plan that's a formal retirement plan where they can save. It's not based on their years of service. It's not based on their salary. It's not based on their income. It's based on how much that employer does match. Some do match, some don't. And it's also based on how much that individual puts back for their future. So it's a 401k plan. It could also be a 403b for certain church organizations, and that's considered a public as well. So when you compare and contrast those two, the retirement plan that you see, pensions, when you see that, that's typically what our grandparents grew up with. Again, within the public sector, typically that's what you're going to find, but you still have that way to supplement with a 403b or a 457 plan. So another way to save for your retirement. The question that he had was, which is better? And it really depends. It really depends on how much your needs are at retirement. It depends on what your goals are for retirement. If you're looking to do your 25 years and get out, then there's a great opportunity to work in public service. If you're looking to do your 25 years in a private corporation, you may have to save a little bit more because sometimes those companies don't put back as much. At the end of the day, the question can be answered with just simple financial planning. And that's what we do at a very high level. And we can take it down to a very low level as well with our relationship with people, with our conversations, with the software that we use each and every day through Right Capital. We cover the 6 areas of financial planning, and I'll note those real quick. They're real simple. It's your financial position. That's what's coming in minus what's going out. Obviously, if there's more going out than what's coming in, we've got some issues. We need to address that first. But the importance of your financial position is for the future. We're not going to spend exactly the same thing today that we're going to spend in the future. There's one reason for that, and it's called inflation. We're staring at some inflationary periods right now that we expect, because of all the stimulus money that has been paid out, that we're going to see inflation increase. So that costs you more. What that means is inflation costs you more to put gasoline in the vehicle, to buy the fruits and vegetables that we buy, to buy the stuff that we buy. So in the future, the idea is with 3 or 4% inflation, it's going to cost us more to live, to do the things that we want to do. So we need to consider inflation, and that goes all the way back to today of what your current financial position is. The next 3 areas that we really tie closely together and review is your income tax planning, your retirement planning, and your investment planning. Those 3 are closely tied together because of number 1, and it's your income tax planning. Think about it like this. Your 401k, your pension plan, right now you don't pay taxes on those dollars because you're deferring them for the future. Now, if you save in a Roth 401k, that's a different, and we'll maybe talk about that in a moment, but that's a one-off scenario. But in your 401k, you're saving for the future. In your retirement plan, you're saving for the future. So that lowers your income bracket today, but when you hit retirement, who's standing there? You are going to pay Uncle Sam first before you get paid yourself at retirement. So we need to consider not only what you're doing today from your retirement planning standpoint, but also tomorrow, because uncle's always got their hand out. Now let's talk about your savings account. Let's talk about your investments. Maybe you own some rental property. Maybe you have an outside investment that's paying dividends. That's tax planning for today, because each and every time you receive those dividends, you're going to pay taxes at the end of the year for those dividends or that capital gain or that growth. So your income tax planning is directly tied to your investment planning and your retirement planning. Those are really 3 closely tied together. The next area that we cover is insurance planning. Now, I hope everybody makes it through today, but what happens to your spouse if you walk out today and get run over by a bus? I want to make sure that your goals, that your spouse's goals are considered when we're planning for that. Maybe you have children in the household. We want to make sure that if you can't work tomorrow, not because of COVID, not because of the pandemic, but if you can't work tomorrow because of a serious illness, because of a disability, we want to make sure that your plans stay intact. And finally, the wrap up of all of that is estate planning, making sure that you have a document that says feed me or don't, resuscitate me or don't. Now, I need to preface this with we're not accountants, we're not attorneys, but we work very closely well with them to make sure we're putting the things in place from an income tax standpoint as well as an estate standpoint that you are covered, that your goals are met. So from an impact of your estate, making sure that you have healthcare directives, make sure you have a will, make sure that what you want to have happen at the time of your demise actually happens. The state of Alabama's got you a will right now, and that's through Judge Robertson here in Tuscaloosa or whatever county or state you live in. The probate system is there to efficiently handle your estate. However, there's a much better way to do that. I would much rather you and your family and your counsel make that decision as opposed to the judge down there making that decision. Don't get me wrong, he's a good guy, but I want to make sure that you're making that decision as opposed to somebody else. If you've got young children, we need to consider guardianships. We need to consider conservatorships as well to make sure that those children are taken care of if both you and your spouse are no longer here. So those 6 areas are exactly what we cover with our clients. Those 6 areas are exactly what you need to be covering with your advisor to make sure that not only today your financial picture is intact, but also for the future, that you are considering that whole aspect of financial planning. So that Right Capital software I referenced, it is a software that I employ within my practice. You're welcome to reach out to Maggie at lancehocutt.com if you want some assistance with that software. We would be glad to invite you to use that. And again, it's about planning for not only today, but planning for the future, because we don't know what the future holds. Folks, this is our 2nd edition. I hope that we start to gain some activity. We start to gain an audience. I'm going to count on you to forward our information out. Look at all of our social media like that, so you'll get a notification every time that we're making some posts like that, so you get a notification when we're going live on YouTube Live. And I'm excited about the future of this. We thank you for tuning in. Please dial in. Please give us a call or email us with your questions. God bless you. We look forward to talking with you again next week.